All right. My name is Chris Campbell. I'm a practicing CPA and I work with small to mid-sized businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk a little bit about the ROBS plan and not necessarily how it's done and set up because I had already done a video on that a while ago. Today is more so about how to get out. Now, for those that aren't familiar, specifically what ROBS plan is, I guess to keep it simple, it basically allows you to take your retirement money. And so let's say if you have a 401k, IRA, any sort of retirement plan, and you can actually take those funds to use as startup capital for a new business venture. And it's essentially a tax-free transaction. So you can use that cash that you have saved up and put it into a business. So I see a lot of folks do that, like with franchises. So you can work with your job, saved up quite a bit. You have a nice nest egg, and you can then turn around and use those funds for franchise fees or whatever the case may be to get up and going. And that's a prime example of it, but it doesn't have to be just franchises. Pretty much do it with any business. So not going to get to the nuances of that, but what I wanted to discuss is how you may necessarily want to get out or cancel the ROBS plan. And I've been asked this recently because one of the biggest disadvantages getting into a ROBS plan is that your business has to be set up as a C corporation. And for the most part, especially when you're first starting out, yes, C corporations, I guess for all intents and purposes, for those that are on the smaller end, mid-sized business and C corporations suck. That's just all there's sort of from a tax perspective. So mainly because any draws that you take from the company, you get taxed as dividends plus salary. So long story short, to keep that very simple, you get taxed twice on profits when it comes to a C corporation versus an S corporation where you can be taxed as a corporation, but you avoid that. Right. So just to keep those things simple. So from a tax optimization standpoint, C corps aren't necessarily the best move. However, if you get into a ROBS plan and you want to tap into that money to do your business, you have to be a C corporation. So one of my clients that have done this, they were looking for a way out because now they're a couple of years in. They did the ROBS, they're a couple of years in, and they're looking at all the money they're paying out and pretty much like, well, damn, if I was S corp, I wouldn't be dealing with this. And I'm like, yeah, you're absolutely right. So they were presented with a way of, well, can I just now change over? Now that I did the transaction, can I now change over to an S corp? And unfortunately, it doesn't happen that easy to do it, at least not without creating a taxable event, right? Because at the end of the day, the last thing you want to do is hop to a transaction where you change things over and all of that money that you took out, the 401k standpoint, now becomes taxable. Now you're looking at a huge tax bill, which you didn't anticipate, right? The whole idea is to tap into those funds without paying any taxes. So you want to avoid that. So it had me thinking and going. I said, how can we possibly make this conversion over? Or how can we either switch to an S corp, or how do we just get out of this whole ROBS thing altogether? So just switching over just isn't an option, mainly because it's going to be a taxable transaction. And also the way that the C corporation is structured, or retirement plan as an owner, part of the C corporation. But again, without getting complicated, it's just something that you really just can't do. So how do we avoid this? How do we get out of the ROBS? So that was the next option that I did take a look at and wanted to share. So to get out of the ROBS, it basically requires you to buy all of the stock back. So it's a situation where pretty much the money that you used to get the company going, because that was all startup money, what you really essentially need to do is put the money back into the retirement account. So you have your 401k of the company that you created, and it owns the shares of the company. So you essentially need to buy the shares back from the 401k plan, the money back in a retirement plan. Now, that might be a little cost prohibitive because at the end of the day, you needed the money to get going. So let's say you get the company going, years down the line, you actually start making some good money. And now you have the cash flow to either buy all of the stock, or maybe you're cash flowing enough to get a loan to go ahead to do that. Now your company made cash flowing enough to do that. So you'll get the loan and put the money back into the 401k. Try not to get too complicated with it, but it goes into the retirement plan of the company that you created. And then now at that point, once you do the buyback, you can either take that money out as a distribution or roll that over to a different retirement plan or put the money back. So it could be a play where you have, let's say, a very short-term loan where you take a very short-term loan, buy your stock, put it back in the retirement plan, and then you can distribute yourself the funds and give that money back. Now, when you take that distribution back, it does turn into a taxable transaction. So it might not necessarily be ideal to do, but it could be a situation where maybe you take part of that money back. You don't have to take the whole amount out. So you can control the ball on that as far as how much of it that you would want taxed. But the idea is put the capital in, put it back in this retirement account. You can either take it out or you can roll it over into a different retirement account, put it back to where it originally was, or you would put the money back. But once you do that, the idea is now getting freedom. It could be a situation where you're paying a few extra dollars on the front end. If your business is thriving, you're growing, it could be a good saving for you for taxes on the back end in the long run. So that might be something to consider. But the point of the lesson here is that as long as you are considered within this ROBS plan and you use that 401k money to fund your business, you're stuck with that C corporation until you essentially buy your stock back and put the money back. No just switching out later on. Otherwise, you're going to cost yourself a lot of money. Strongly advise against doing that. All right. So I think that's all for now. And hopefully this was helpful. And if you have any more questions about this topic or any other tax or accounting related questions, feel free to reach out. Happy to help. All right. That's all for now. I'll talk to you next one.